Structural and reduced form models are two major frameworks used to analyze and quantify credit risk. Both approaches seek to estimate the likelihood of default and the value of risky debt, but they differ significantly in methodology and underlying assumptions. Structural models view default as a direct consequence of the issuer's asset value relative to its liabilities, while reduced form models treat default as a random event governed by statistical probabilities. These models play an important role in modern credit analysis, bond valuation, and risk management by helping investors estimate default probabilities, expected losses, and appropriate compensation for bearing credit risk. Structural models are based on the idea that a company's assets provide the economic support for its debt obligations. Default occurs when the market value of a firm's assets falls below the value of its liabilities, leaving insufficient resources to repay creditors. In this framework, equity can be viewed as a call option on the firm's assets because shareholders receive residual value only after debt holders have been paid. Factors such as asset volatility, leverage, asset value growth, and debt maturity influence default risk. Structural models therefore establish a direct economic relationship between firm value and credit quality. One advantage of structural models is their strong theoretical foundation and intuitive economic interpretation. Because default is linked directly to balance sheet strength and asset values, these models provide insights into the drivers of credit risk. However, they also face practical limitations. Asset values and asset volatility are not directly observable and must often be estimated, introducing potential errors. In addition, structural models may struggle to explain sudden defaults that occur despite apparently healthy financial positions. Consequently, while useful for understanding long-term credit dynamics, structural models do not always capture the complexity of real-world default behavior accurately. Reduced form models address many of these limitations by treating default as an unpredictable event that occurs according to a statistical process. Rather than modeling firm assets directly, these models estimate default probabilities from observable market information such as bond prices, credit spreads, and credit default swap premiums. Default intensity, often referred to as a hazard rate, measures the conditional probability of default over a given period. This approach allows reduced form models to incorporate changing market expectations quickly and efficiently. As a result, they are widely used in pricing credit-sensitive securities and managing credit risk exposures. Credit spread analysis focuses on understanding the additional yield investors require for bearing credit risk. A credit spread represents the difference between the yield on a risky bond and the yield on a comparable default-free benchmark security. Although expected default losses are a major component of credit spreads, spreads also reflect uncertainty regarding losses, liquidity conditions, risk aversion, and market sentiment. Changes in economic outlook, industry conditions, and issuer-specific developments can significantly influence spread levels. Consequently, credit spreads provide valuable information about market perceptions of credit quality and serve as important indicators of changing risk conditions. Effective credit spread analysis requires decomposing spreads into their underlying drivers and evaluating whether compensation adequately reflects risk. Analysts examine factors such as probability of default, recovery rates, business fundamentals, leverage, industry conditions, and macroeconomic trends. Wider spreads generally indicate higher perceived risk or reduced market liquidity, while narrower spreads suggest improving credit conditions. Comparing spread levels across issuers, sectors, and time periods helps investors identify relative value opportunities and assess market expectations. Together, structural models, reduced form models, and credit spread analysis provide complementary tools for evaluating credit risk, valuing fixed income securities, and constructing well-informed investment strategies.